November 7th, 1930. Federal Reserve Bank of New York. Midnight. George L. Harrison stands alone in his office on the 10th floor, staring at a telegram from the Bank of England. The words blur together, but the message is clear. Gold is hemorrhaging from London. Sterling is under attack. European banks are collapsing. And now, the pressure is turning toward America. Harrison is 38 years old. He became president of the New York Fed just 2 years ago, after the sudden death of Benjamin Strong, the titan who had shaped American monetary policy for a generation. Strong had been Harrison's mentor, his guide through the labyrinth of international finance. Now Harrison stands in Strong's office, facing a crisis Strong never had to confront, armed with principles Strong had drilled into him: defend the gold standard, maintain discipline, protect the dollar's integrity at any cost. Outside his window, Wall Street lies dark and silent. But Harrison knows what's coming. He's seen the reports: banks failing in Kentucky, depositors lining up in Tennessee, credit freezing in the Midwest. The stock market crash of October 1929 was supposed to be a correction, a healthy purging of speculation. It's been 13 months. The economy is still falling. And now this. Gold flowing out of American vaults, seeking safety in European central banks, destabilizing the entire monetary system. Harrison lifts the phone. His hand is steady. His voice is calm. "Raise the discount rate," he says. 1 full percentage point. Effective Monday morning. The line goes silent for a moment. Then, "Sir, that will tighten credit across the entire banking system." "I'm aware," Harrison replies. "We must defend the gold standard. There is no alternative." He hangs up. The decision is made. By morning, the order will ripple through every bank in America. Credit will contract, loans will be called in, interest rates will spike. Thousands of banks, already weakened, already struggling, will face a sudden, crushing squeeze. Harrison believes he is saving the system. He is about to accelerate its destruction. The world financial system in late 1930 operates on a single iron rule: gold is money, and money is gold. Every dollar in circulation must be backed by gold reserves. Every central bank must stand ready to exchange paper currency for gold on demand. This is the gold standard, and it is not merely policy. It is orthodoxy, gospel, the foundation of economic civilization. But the gold standard has a dark side. When gold flows out of a country, that country's money supply must contract. When money supply contracts, credit vanishes. When credit vanishes, banks fail. When banks fail, the economy collapses. This is not theory. This is mechanical, inevitable. And in October 1930, gold began flowing out of the United States in terrifying quantities. $250 million in October alone. Another $150 million in early November. European banks, desperate for liquidity, are pulling gold from New York. French central bankers, paranoid about their reserves, are converting dollars to gold and shipping it to Paris. The entire international monetary system is seizing up, and every central banker knows the rule. Defend your gold reserves. Defend them at any cost. Harrison knows this rule. He learned it from Benjamin Strong, who learned it from the great European central bankers of the pre-war era. The rule has been tested in crises before, 1907, 1920, and it has always held. Defend the gold, maintain discipline, the markets will stabilize. But this time is different. This time, the American economy is already in free fall. Industrial production has dropped 17% since the stock market crash. Unemployment has doubled. Banks are failing at a rate of dozens per month. The agricultural sector is in collapse, with commodity prices crashing and farmers defaulting on loans across the Great Plains. And into this inferno, Harrison is about to throw gasoline. Monday morning, November 10th, 1930. The announcement hits Wall Street like a thunderclap. Federal Reserve Bank of New York raises discount rate from 2% to 3%. Financial journalists are stunned. Bankers are confused. Economists are divided. The discount rate is the interest rate at which commercial banks can borrow from the Federal Reserve, the emergency valve that keeps credit flowing during crises. Raising it means making credit more expensive, harder to access, tighter, during a credit crisis, during a banking panic, during a depression. The financial press struggles to explain it. The New York Times runs a careful analysis. Fed moves to protect gold reserves. The Wall Street Journal is more direct. Monetary discipline restored. But in small towns across America, bank presidents read the news and feel their stomachs drop. In Springfield, Illinois, a banker named Charles Dawson has been fighting for months to keep his institution afloat. Deposits are draining. Borrowers are defaulting. His reserves are thin. He's been relying on the ability to borrow from the Federal Reserve if things get desperate. Now that lifeline just became more expensive. Now the cost of survival just went up. Dawson sits in his office, staring at the telegram, and realizes the Federal Reserve just made it harder for him to save his bank. Across the country, thousands of bankers are having the same realization. The trap is closing. To understand what happened next, you must understand gold. Imagine a nation's economy as a body, and money as its blood. Credit is the circulation system, loans flowing through arteries, keeping businesses alive, wages paid, growth sustained. The gold standard is a tourniquet, fixed tight around the arm, limiting how much blood can flow based on how much gold the nation holds. When gold flows out, the tourniquet tightens, blood flow slows, circulation weakens, the body grows cold. This is not a metaphor. This is the mechanical reality of the gold standard. Every dollar in circulation had to be backed by 40 cents of gold in Federal Reserve vaults. When gold left the country, the Fed was legally required to contract the money supply. Fewer dollars in circulation meant higher interest rates, tighter credit, vanishing loans. It meant deflation, prices falling, wages falling, debts becoming heavier in real terms. In theory, this was supposed to be self-correcting. When gold left, prices would fall, making American goods cheaper and more competitive. Exports would rise, gold would flow back in, balance would be restored. In theory. But reality in 1930 was different. Prices were falling, but wages were sticky. Employers couldn't cut wages fast enough without triggering strikes and unrest. Debts were fixed in nominal terms, so as prices fell, the real burden of debt increased. Farmers who borrowed $10,000 to buy land now owed the equivalent of $15,000 in purchasing power. Businesses that took out loans to expand were drowning in obligations they could never repay. And the banks were trapped between collapsing asset values and fixed deposit obligations. They held mortgages on farms worth half what they were a year ago. They held loans to businesses that would never reopen. Their assets were evaporating while their depositors demanded cash. The gold standard offered no mercy. It demanded discipline. George Harrison was a disciple of discipline. Federal Reserve Board Minutes, October 24, 1930. The board discussed at length the outflow of gold and its implications for monetary stability. Governor Harrison emphasized that maintenance of gold convertibility must take absolute priority over any domestic considerations. A defense of gold reserves is not merely prudent. It is essential to preserve confidence in the dollar and prevent a wholesale flight from American securities. The language is clinical, bloodless. These men are discussing the fate of millions using the vocabulary of accounting. Harrison believed, genuinely, deeply, that defending gold was defending America. To let gold drain away was to invite chaos, hyperinflation, currency collapse, economic anarchy. He had seen what happened to Germany in 1923, when the Reichsmark became worthless and people carried money in wheelbarrows. He had watched European currencies destabilize in the 1920s. He knew the horror stories. The gold standard was the anchor. Discipline was the answer. But across America, ordinary people didn't understand gold flows, or reserve requirements, or monetary discipline. They understood only this: the banks were failing, jobs were disappearing, and credit was vanishing. And now the Federal Reserve was making it worse. In Des Moines, a hardware store owner applied for a loan to buy inventory for spring. His bank refused. "The Fed just raised rates," the banker explained. "We can't extend credit right now." The store owner didn't understand. "But I've been a customer here for 15 years. My credit is good." "It's not about your credit," the banker said quietly. "It's about the system." The store owner went home and told his wife they might have to close. She didn't understand either. Nobody did. And in New York, George Harrison read reports of credit contraction across the Midwest and wrote in his diary, "The medicine may be bitter, but it is necessary. We must maintain discipline." The mechanics of destruction were elegant in their simplicity. Step 1. The discount rate increases from 2% to 3%. Step 2. Commercial banks, already weak, face higher costs to borrow from the Fed. Step 3. Banks pass those costs to their customers or refuse to lend at all. Step 4. Businesses can't get credit. Farmers can't get crop loans. Homeowners can't refinance mortgages. Step 5. Spending collapses. Defaults rise. Banks fail. Step 6. Depositors panic and withdraw their money, triggering runs. Step 7. More banks fail, destroying more deposits, contracting the money supply further. Step 8. The cycle accelerates. By December 1930, the U.S. money supply had contracted by 3.5% since the rate increase. By March 1931, another 4%. Banks were failing at a rate of 60 per month. Not small country banks, regional institutions with millions in deposits, cornerstones of their communities, suddenly gone. The Bank of United States failed on December 11, 1930. Not a government bank, a private institution with a misleading name. But it held 200 million in deposits, most of them belonging to working-class immigrant families in New York. When it collapsed, 400,000 depositors lost everything. Entire neighborhoods were wiped out financially overnight. Harrison read the reports. He wrote in his journal, "Regrettable but necessary adjustments are occurring." In Kansas, a wheat farmer named Daniel Hoffman went to his bank in February 1931 to apply for a crop loan. He needed $800 to buy seed and hire help for spring planting. He'd been farming the same land for 20 years. His father had farmed it before him. The banker looked uncomfortable. "Dan, I can't help you." "Why not? I've never missed a payment." "It's not you. It's the Fed. They've tightened everything. We don't have the reserves to make new loans." Hoffman stared at him. "So what am I supposed to do?" The banker had no answer. Hoffman went home and told his wife. They had 3 children. They had $87 in savings. If they couldn't plant, they couldn't harvest. If they couldn't harvest, they couldn't pay their mortgage. If they couldn't pay their mortgage... He didn't finish the thought. Across Kansas, thousands of farmers faced the same calculation. Across Iowa, across Nebraska and the Dakotas and Oklahoma, the credit that had fueled American agriculture for generations was simply gone. In Detroit, an auto parts manufacturer named Joseph Klein watched his business die in slow motion. He'd been manufacturing brake components for Ford and Chrysler. Business had been weak since the crash, but manageable. Then, in January 1931, his bank called in his line of credit. "Why?" Klein demanded. "I'm current on all my payments." "Bank policy," the loan officer said. "We're reducing exposure across the board." Klein tried 3 other banks. None would extend credit. Without credit, he couldn't buy raw materials. Without materials, he couldn't fulfill orders. Without orders, he couldn't pay his workers. In March, he laid off half his staff, 60 men. In May, he closed the plant entirely. Those 120 workers went home and told their families. Rent went unpaid, grocery bills went unpaid, children's shoes wore through, and there was no money for new ones. The credit contraction didn't just hurt businesses, it destroyed livelihoods, shattered families, hollowed out communities. And in New York, George Harrison read reports from Federal Reserve District banks detailing the credit squeeze and wrote, "Member banks must adjust their portfolios to reflect current conditions. We cannot sacrifice monetary stability for temporary accommodations." Temporary. He believed it was temporary. The spring of 1931 marked the beginning of the true catastrophe. What had been a severe recession became something else entirely. A systemic collapse, a cascade of failures that fed on itself, growing more violent with each passing month. The numbers tell part of the story. Between January and August 1931, 1,300 American banks failed. That's more than 5 banks per day, every day, for 8 months. Those banks held $1.3 billion in deposits, money that simply vanished, erased from existence, destroying the savings of millions. But numbers can't capture the sound of those failures. The pounding on locked bank doors, the screaming of depositors who arrived to find their life savings gone, the quiet sobbing of elderly couples who'd worked 50 years and now had nothing. Chicago, June 1931. A crowd gathers outside the First National Bank of Chicago at dawn. The night before, rumors spread that the bank was insolvent. By sunrise, 3,000 people are pushing against the doors, demanding their deposits. The bank is actually sound, one of the strongest in the city. But perception is reality in a banking panic. If enough people believe a bank will fail, it will fail, crushed by the weight of its own depositors' fear. The bank's president stands inside the lobby, watching the crowd grow. He's called the Federal Reserve, begging for emergency liquidity. The Fed's answer, "Maintain your reserve requirements, liquidate assets if necessary." But assets can't be liquidated fast enough. Mortgages take weeks to sell. Bonds are trading at 50 cents on the dollar. The crowd is here now, demanding cash now. The president makes a decision. He opens the doors. For 4 hours, tellers count out cash, draining the vault, trying to satisfy the panic. By noon, the bank has paid out $8 million. By 2 p.m., $15 million. At 3 p.m., the cash runs out. The bank closes. Permanently. 3,000 depositors who didn't make it to the front of the line lose everything. This scene repeated itself in Cleveland, in Philadelphia, in St. Louis, in dozens of cities across the country. Banks that might have survived with Federal Reserve support were left to die, sacrificed on the altar of discipline and sound money. Harrison received daily reports. He read them with growing concern, but his faith never wavered. In a speech to the New York Bankers Association in July 1931, he declared, "The path of monetary rectitude is never easy, but history shows that nations which maintain discipline through crisis emerge stronger." History would judge him differently. As banks failed, deflation accelerated, prices fell and fell and fell. Wheat that sold for $1.50 a bushel in 1929 sold for 60 cents in 1931. Corn fell from 80 cents to 30 cents. Cotton fell by half. For farmers, this was annihilation. They couldn't lower their costs fast enough to match falling prices. Mortgages stayed the same, $10,000 owed, but the crop that might have paid that mortgage was now worth $4,000. Foreclosure auctions became a plague on the Great Plains. County sheriffs, following court orders, seized farms and auctioned them to the highest bidder. Sometimes neighbors would band together, intimidating outside bidders, buying the farm for pennies and giving it back to the original owner. Sometimes there were no neighbors left. They'd already lost their own farms. One farmer in Iowa, facing foreclosure, loaded his rifle and told the sheriff, "You'll take this land over my dead body." The sheriff called for backup. The farmer surrendered. 3 weeks later, he hanged himself in his barn. The local newspaper ran a short obituary. It didn't mention that Federal Reserve policy had helped kill him. Industrial production collapsed with equal violence. Steel production in 1929, 56 million tons. Steel production in 1931, 26 million tons. Half the industry gone. Auto production fell by 75%. Construction fell by 80%. Consumer spending fell by 30%. Every percentage point represented real human beings. Workers laid off. Families evicted. Children pulled from school to work or beg. In Pittsburgh, unemployment reached 50%. In Cleveland, 60%. In some coal mining towns in Pennsylvania, 80%. Men who'd worked their entire adult lives, skilled tradesmen, experienced laborers, stood in soup kitchen lines, staring at the ground, unable to meet anyone's eyes. The shame was crushing. In the America of 1931, unemployment wasn't seen as an economic problem, but a moral failure. If you couldn't find work, something was wrong with you. Women watched their children grow thin and didn't know how to explain why there wasn't enough food. And George Harrison, reading Commerce Department reports on declining production, wrote in his journal, "The adjustment process continues. We must maintain our resolve." Then the crisis went global. May 11th, 1931. Austria's Kreditanstalt, the largest bank in Central Europe, collapsed. It held deposits from across the continent. Its failure triggered panic in Germany, Hungary, Poland. European banks began withdrawing gold from New York at an accelerated rate. The hemorrhage Harrison had tried to stop by raising rates in November was now a full arterial bleed. The Federal Reserve faced a choice: let gold flow out and watch the money supply contract further, or abandon the gold standard and reflate. Harrison never hesitated. On September 15, 1931, with bank failures accelerating, with unemployment approaching 20%, with deflation tearing the economy apart, the Federal Reserve raised the discount rate again, from 1.5% to 3.5%, the largest rate increase in Federal Reserve history, in the middle of the worst economic collapse in American history. Fed minutes from September 15th. Governor Harrison argued forcefully that defense of the gold standard must override all other considerations. The integrity of the dollar is at stake. British central bankers, watching in horror, sent a cable: "You are exporting depression to the entire world." 6 days later, Britain abandoned the gold standard. The United States stood alone, clutching its gold, watching its economy die. Abstract policy became concrete suffering. In New York City, bread lines stretched for entire blocks. Men stood for hours in the cold, waiting for a bowl of soup and a piece of bread. The lucky ones got 2 meals a day from charity kitchens. The unlucky starved. In Chicago, families burned furniture to stay warm, unable to afford coal. They burned books. They burned the wooden trim from their apartments. Landlords evicted them, and they moved into shanty towns, collections of scrap metal shacks called Hoovervilles, after the president who seemed powerless to help them. In rural Oklahoma, a teacher named Mary Henderson wrote in her diary, "Another student fainted today during class. That's the 3rd this week. They're not sick. They're hungry. Their parents have nothing to feed them." She used her own salary, $40 a month, to buy bread and hand it out discreetly. It wasn't enough. It was never enough. In the summer of 1932, 20,000 World War I veterans marched on Washington. They'd been promised bonuses, payable in 1945. They wanted them now. They were starving. They camped on the National Mall, built a tent city, and petitioned Congress. Congress refused. President Hoover ordered the army to evict them. General Douglas MacArthur led troops with fixed bayonets and tear gas into the camp. Tanks rolled through the tents. Veterans, men who'd fought for their country, who'd survived the trenches of France, were driven out like criminals. 2 veterans died. A child was killed by tear gas. The newsreels showed American soldiers attacking American veterans, and the country watched in shocked silence. In his office in New York, Harrison read the newspaper coverage and felt a flicker of unease, but his diary entry that night remained firm. Difficult times require difficult choices. We cannot abandon no sound monetary principles simply because conditions are harsh. By the end of 1932, the statistics were almost incomprehensible. 25% unemployment, 5,000 banks failed since 1930, 50% decline in GDP, 30% deflation, 2 million homeless, 34 million people with no income whatsoever. But statistics don't bleed, they don't starve, they don't stand in bread lines or bury children who died of malnutrition. Behind every number was a human being whose life was destroyed. By late 1931, doubt was creeping into Federal Reserve Board meetings. Minutes from December 1931 show the first cracks in the consensus. Several governors expressed concern that monetary tightening may be exacerbating the banking crisis rather than containing it. Harrison's response was swift and certain. We cannot abandon our principles in the face of adversity. That is precisely when principles matter most. But outside the Fed, economists were beginning to whisper heresy. John Maynard Keynes, writing from Cambridge, published a devastating critique. The gold standard has become a barbarous relic, a suicide pact among central bankers who would rather destroy their economies than admit their doctrine is flawed. In America, economists like Irving Fisher began publishing papers on debt deflation, the spiral in which falling prices increase the real burden of debt, causing more defaults, more bank failures, more deflation. Fisher argued that the Federal Reserve's tight money policy was accelerating this death spiral. The Fed dismissed him. Fisher had lost his personal fortune in the crash. Clearly his judgment was compromised. But the evidence kept mounting. Countries that abandoned gold early, Scandinavia, Japan, were recovering faster. Countries that clung to gold, the United States, France, were sinking deeper into depression. International bankers began pleading with Harrison to ease. The Bank of England sent a formal request. For the sake of the global economy, please consider monetary expansion. Harrison refused. In a confidential memo to the Federal Reserve Board, he wrote, "We will not sacrifice American monetary integrity for European convenience." Fed staff economists produced internal reports showing the correlation between tight money and bank failures. They showed the Fed's own data: money supply down 30%, prices down 30%, GDP down 50%. The reports landed on Harrison's desk. He read them carefully. Then he filed them away and ordered another defense of the gold standard. Years later, a Fed staffer would recall, "It was like watching a man convinced he was giving medicine to a patient, unable to see that he was administering poison." The banking system held until it didn't. February 1933. Michigan declared a bank holiday, closing every bank in the state to stop runs. Within days, Maryland followed, then Ohio, then Indiana. By the first week of March, 32 states had closed their banks. The American financial system was in cardiac arrest. On March 4, 1933, Franklin Delano Roosevelt was inaugurated as president. His first act, declare a national bank holiday, closing every bank in America. His second act, abandon the gold standard. The reaction was immediate. Within days, Roosevelt signed the Emergency Banking Act, restructuring the system. Within weeks, he took the United States off gold domestically, breaking the chains that had bound Harrison and his predecessors. And the economy began to breathe. Stock prices rose 15% in the first week. Bank deposits stabilized. Credit began flowing again, slowly, tentatively, but it flowed. George Harrison watched from his office as everything he'd fought to preserve was dismantled. He'd defended gold for 3 years. He'd maintained discipline. He'd refused to compromise. And Roosevelt undid it all in 2 weeks. Harrison wrote in his diary, "The president has chosen expediency over principle. History will judge whether this gambit succeeds." History did judge. but not the way Harrison expected. The financial press understood immediately. The Wall Street Journal, March 15th, 1933. The economic patient began to breathe again the moment the tourniquet was removed. By the end of 1933, industrial production had risen 40%. By 1934, GDP growth turned positive for the first time in 4 years. Unemployment remained catastrophically high. Recovery was slow and painful, but the free fall had stopped. The gold standard, the sacred cow Harrison had defended at any cost, was revealed as the chain that had dragged the economy down. Countries that abandoned gold early recovered fast. Countries that held on, France, Belgium, suffered for years longer. The data was undeniable. The experiment was complete. The verdict was in. 40 years later, economists Milton Friedman and Anna Schwartz published A Monetary History of the United States. Their analysis of the Great Depression was devastating and unequivocal. The Federal Reserve had it in its power to prevent the decline in the money supply, or to increase the supply so as to offset the decline. It failed to exercise that power. The result was the most severe contraction in output and prices in American history. In other words, the Fed caused the Great Depression, not the stock market crash, not overproduction, not trade wars or bank failures or any of the other factors historians had blamed. The Federal Reserve's tight money policy, the deliberate systematic contraction of credit in the face of collapsing demand, turned a recession into a catastrophe. Christina Roma, decades later, would put it even more bluntly. The gold standard was the mechanism of transmission, but Federal Reserve policy was the cause. They had the power to save the economy and chose not to use it. Barry Eichengreen's research showed the pattern globally. Countries that left gold early recovered fastest. Countries that stayed on gold longest suffered most. The correlation is nearly perfect. Modern central bankers study the 1930s obsessively, determined never to repeat Harrison's mistake. Ben Bernanke, chairman of the Federal Reserve during the 2008 financial crisis, wrote his doctoral dissertation on the Great Depression. When Lehman Brothers collapsed, triggering a credit freeze eerily similar to 1931, Bernanke flooded the system with liquidity. The Fed's balance sheet expanded by trillions. Interest rates went to zero. Critics called it reckless. Bernanke called it learning from history. The economy recovered. Disaster was averted. Bernanke later said, "We spent 80 years studying what went wrong in the 1930s. We weren't going to make that mistake again." George Harrison retired from the New York Fed in 1940. He never publicly acknowledged that his policies had deepened the Depression. In private correspondence, he remained convinced he'd done the right thing, that defending gold had been necessary, even if painful. He died in 1958, respected by his peers, remembered as a steady hand during difficult times. History remembers him differently. One order, given by one man on one night in November 1930, helped turn a recession into a catastrophe. Harrison didn't cause the stock market crash. He didn't create the banking weaknesses. He didn't manufacture the agricultural collapse. But he took a sick economy and bled it further. He took credit starvation and made it policy. He took panic and codified it into monetary doctrine. He believed he was protecting America. He believed gold was sacred, discipline was virtue, tightening was necessary. He believed theory over evidence, doctrine over reality, abstract principles over human suffering. And millions paid the price. History remembers the breadlines and the Hoovervilles and the bonus army. It remembers unemployment and deflation and bank failures. It rarely remembers the moment when it all accelerated. The midnight decision in a New York office, the telegram from London, the belief that defending gold was worth any cost. But the moment mattered. The decision mattered. In the archives of the Federal Reserve Bank of New York, there's a file from 1933. It contains internal memos written as Roosevelt took America off gold, and the economy began its recovery. One memo, unsigned, undated, bears a single haunting line. "We defended gold, but we lost the nation." The file was sealed for 50 years. When historians finally opened it, they found the truth that Harrison never admitted publicly. He knew. By the end, he knew. But it was too late. The damage was done.